Hey guys, my name is Max Convexity. Hope you guys are having a great day wherever you're at. Thanks for joining my channel again. I wanted to look in on two funds that I reviewed a while back, and I want to take a look and kind of compare them and see what we're looking at nowadays. All right, so I want to look at BALI and GPIX today. BALI is a iShares fund, which is BlackRock, and GPIX is Goldman Sachs. All right. So this is the battle of the big dogs. All right. Well, first thing I noticed when I was doing research, I compare everything to GPIX because, well, every high yield NASDAQ fund for sure, because GPIX is kind of the gold standard of high yield NASDAQ funds, right? Well, so I was noticing the BALI and GPIX have almost identical performance to GPIX. So anyway, then I compared BALI to Goldman, which I just should have done off the bat, and they're virtually the same. I think these guys are all using the same playbook. I've talked about it before, and I'm not going to go in depth in here, but there is a back test out there on the internet by the Chicago Board of Options Exchange, and it went from 86 or 87 to 2013, and they had a benchmark on that beat buy and hold, and beat it by a pretty good percentage. And it was a covered call fund, and it was a monthly covered call strategy where they sold, I can't remember, it was either the 30 delta or 2% out of the money. In any case, that's a similar strategy. I think it was the 30 delta. I think it's the BXMD is the name of it. Is the initials of the CBOE. It's called a strategy index. Well, anyway, I think that GPIQ and these other funds are trying to recreate that test or parts of it. Now, these guys do some of their own stuff that's not in the test. I'm not just saying they're ripping off the test, but that test is kind of what we're looking for as a covered call. The thing they teach you about covered call funds is they don't outperform the underlying, don't usually outperform the underlying. That doesn't mean they can't, you know. All right, so it's not a bad thing to copy GPIX, and it's not a bad thing that GPIX is copying that benchmark. Those are good things to copy. Being able to beat, over a significant period of time, that's the whole key to money management, or that's what you're looking for. That's the holy grail of money management, is being able to outperform the buy and hold, outperform the S&P, especially if you can do it with less risk. And guess what? When you're doing a covered call strategy, you're doing it with less risk. So those strategies that outperformed didn't only outperform on a risk-adjusted basis, they outperformed on an absolute basis. Okay, tell of the tape. So, like I say, this isn't a GPIX review, but I always put the other funds in there just to compare with. Like on the last one, I got a little bit of a bad comment about, putting in too many funds or whatever. I did kind of go off on some wild branches on that last review, but I do like to put in other funds just so I can see how these funds are, how they compare. Okay, so GPIX, it's 11 billion under management. Now the expense ratio, they're Goldman's the best, and I think that's the best in the industry. That's the lowest covered call one out there right now. I think that's kind of their deal, is they have the lowest expense ratio. But look at this, these funds are tiny. There's people that work at Goldman that make more than that every year. 77 million is not a lot of money anymore. Especially for assets under management. Probably every vice president they have has more than that, in their bank account right now. It's a tiny fund. And BALI's even worse. I can't understand why people aren't buying this fund. Hopefully after people see this review, they will, because these funds are badass. And I've been singing BALI's praises for a while. I mentioned BALI often, but I didn't realize how badass GPIX was. It should definitely have more than 77 million under management. That's all I'm saying. Jackson, I don't think Jackson agrees with me. I think he's getting bored. All right. Well, let's get this show on the road. We're going to look at the prospectuses real quick, review the strategies and talk about them. And then we'll look at the performance. I'll let you guys get out of here. Okay, so on to the prospectuses and the stuff I found on the internet. So let's start over here with BlackRock. Okay, that's just their webpage. This is their prospectus. So their principal investment strategy is consistent income with lower volatility. They never mention in here they're trying to capture upside. So, you know, that's good. Keep expectations low. I'm going to tell you this, though. They are capturing a shit load of upside, a ton of it. But anyway, great fund. I've talked about this fund before. Basically, what they do, the too long don't read. I'll break all this down for you. They sell covered calls on the index, and they do it on anywhere from 30% to 70% based on conditions. And it's a quantitative model they follow using quantitative analysis. So they forecast models that prioritize, you know, what they think is going to happen in the future. So what they can do is they will change the stocks in their underlying, the stocks that they own. They don't just blindly buy the index like a lot of these do. They buy parts of the index that they want. And they will switch out stocks to be more defensive or less defensive depending on how the market's going. And they'll also change their option strategies. It's all quantitative and stuff. So yes, these guys are capturing a ton of upside, presumably because their quantitative models are working, the market's going up, and they're full bore ahead. So we'll see if their quantitative models make them do as well on the downside as they've done on the upside. The problem with passive funds that do well on the upside, that have a lot of upside and not much buffer, is they're also, if they're passive, they're also going to perform that way on the downside, which means not a lot of buffer, which means they'll catch a lot of downside. So, all right. So that is BlackRock in a nutshell. Here's their holdings. And the only thing I found about their holdings that was interesting is they actually hold futures. And I looked into it a little bit more. They hold they hold all the individual stocks. You can see they have tons of, you know, Microsoft, just like they all do, and Apple. They hold all the individual stocks. But they sell options on the index options, so they get the favorable tax treatment. Same thing everyone does. Holds the stock, sells the index. But in addition, they make a little more stock synthetically by buying futures. So they have, and their theory to doing that is that gives them some more upside cap, because it gives them more upside with the futures, and it gives them a little bit of leverage. And it's not a huge amount of futures. It's about a tenth of the size of their cash position. It's just a little booster that gives them some more upside. And I think it's a fine plan. Other than that, they're just selling calls on the index, and they ladder them out every week, their monthly calls. So that's very nice. It's a nice fund. Nothing wrong with that. GPIX, it's pretty much the same thing. Now, they're a little bit more secretive. They don't mention the futures in their prospectus, but the way they've been performing, where it's just virtually the same performance, I really think, and plus I did another review on these guys, or I've seen a review on these guys, and I swear these guys have a futures component too, where they're getting a little bit of extra upside. Well, in any event, they have virtually all the same stuff in their prospectus. They don't even, but get what they say for they put their objective even a little bit different. They say they seek current income while maintaining prospects for capital appreciation, which is a good way of putting it. And they've been maintaining their prospects well, because when we get to the performance part of the next section, you're going to see they've been getting a lot of upside. Small management fee. I mean, what's not to like about this? This is also quant driven. They also talk about in here about not overriding the whole portfolio. They do a different percentage based on conditions too, of override. It's not a total override, and it's quantitatively driven. So I'm just going to call these funds pretty much, it's buyer's choice or whatever. I don't know. I mean, they're very similar, very similar. Let's look at that. I mean, the main thing, right? I mean, how we pay the bills is with total return. Total return is all that counts. That's always what guys like me say, right? Well, okay, let's look at the total return, or let's look at the performance. So I get on there and I pull up this chart, and I look at it. The top two lines are SPY and the triple Qs, and I look at it and I go, yeah, these are pretty good, about typical. I always say in line, or that, they're getting about 75% of the parent's upside. So I say that's good, whatever. I want to show you something funny I did, or I thought it was funny. I thought it was funny. Yeah, I was looking at this chart right here, and I was going, yeah, that's, parents are getting 17, 18%, kids are getting, 12, 13, and 10. So that's about the ratio I would normally expect. And then I'm thinking, that's cool. Then I made the old rookie mistake of looking at price return. The reason these returns look so bad is because this right here includes the decay. Of course, the decay is just the option coming out. So even ETFs that don't look like they have decay, any ETF that pays a dividend, I mean, it's the dividend coming out, that pays a dividend, it's going to decay. The NAV's going to decay a little bit. Anyway, look over here when we take the decay out and put just total return. Look at this. Now, this was impressive. GPIX over 6 months, and that's all these funds have been around. So we're going to test it over 6 months to make apples to apples. But anyway, over 6 months, GPIX almost beat buy and hold. I mean, just almost beat the benchmark, in other words, passively just. I mean, that's amazing. The last little thing I show there shows GPIX 19.3%, triple Q's 19.8%, and SPY almost 21%. It's been a great, not often that SPY outperforms triple Q's, but for this past little 6 months, they have just barely. In any event, I like these. I mean, these are in the other ones performed. Look at BALI, 16%. GPIX is actually the worst of all three of them. And I have a theory on that. It's because GPIX doesn't use futures. So GPIX will presumably do a little better on the way down, because if these guys keep their futures, that the leverage hurts them on the way down too. So the real high flyers on the way up are going to be low flyers on the way down. But because these guys are quantitatively driven, they probably won't have their futures position on the way down, is what I'm thinking. I sure hope they don't. Anyway, that's why channels like me are here to, to kind of keep an eye on these and review these. I like to look at these types of funds every day. It's kind of what I do. So they're both algo driven, of course. They all do covered calls. They all do monthlies. They all do them in weekly tranches. BALI owns futures. I guarantee that other one does too. Some of them leave it in the comments. Yes, and of course, both of these funds do want to be GPIX when they grow up. But don't we all? If you're GPIX, that means you're a billionaire. It has $8 billion under management. In the fund family, between GPIX and the other and GPI, they're it's like 50, 40, 45 billion or something. It's massive. It's massive. But you can see the funds that are younger, and they're younger, and Goldman isn't younger necessarily company. The fund's younger, just has 77 million under management and 29 million under management. These are tiny funds, but I don't see why it can't get a big piece of that market. Now, remember what Sylvia said? She was on Retire on Dividends pod yesterday, and they were talking about, these funds when they reach a break-even point, Well, anyway, I bet you both of these funds are under the break-even point. Although maybe these companies are so big, they really don't have a break-even point. They can probably put funds out there and for free and use them as a loss leader or something. But in any event, I don't know. I love them and everything. My only caveat about these is I just can't understand why more people don't own these. I don't know if there's something wrong with them that I don't know, I haven't noticed yet, or if people just aren't into the 8 to 10% dividend, I mean, that could be part of it. But I mean, JetQ pays 8 to 10%, and you know what I'm saying. So I don't know. Let me know in the comments if you guys have any idea why these funds aren't more widely held. Anyway, like I say, my name's Max Convexity. Check all this out with your own financial planner. This is just for research purposes and entertainment, but hopefully research. Research and education more so than entertainment, but it's for all three of them. In any event, you have any questions, please put in the comments or get a hold of me on Discord. I'm on multiple Discords. Someday I might start my own server. I've been thinking about it, but it's just, I don't know. I just don't want to get in that deep. I would just rather be a guest on Retire on Dividend server my whole life, I think. But I don't know. We'll see. Maybe I'll start my own server someday. All right, guys. You guys have a great day, and I will talk to you later. Bye.